The world is teetering on the edge of the biggest oil crisis of our lifetime. Lark Davis reports that with the Strait of Hormuz closed, 20% of the world's oil supply is cut off, and prices could rocket to $200 a barrel. This isn't just about energy prices either. As CryptoTips points out, this is part of a larger geopolitical storm, with massive war spending further threatening the US dollar's long-term stability. But just as the case for a decentralized hedge gets stronger, a new threat is emerging from within. Coin Bureau reveals that while a controversial proposal to fork Bitcoin was rejected, it exposed a terrifying new reality. Wall Street firms, through their spot ETFs, now hold the power to become kingmakers in any future network disputes, fundamentally challenging Bitcoin's core principles. Amidst this uncertainty, some are looking elsewhere. According to CryptoWendy, analysts are pointing to assets like XRP, citing its AI synergy and banking connections as a better bet for short-term gains. So, with Bitcoin stuck at its late 2021 price and threatening to break below the critical $64,000 support level, which threat will break it first?
In the latest video from Lark Davis' channel, he's breaking down the massive implications of what he calls the biggest oil crisis of our lifetimes. It all stems from the closure of the Straits of Hormuz, which has choked off 20% of the world's oil supply and sent crude prices rocketing up 28% at the market open. To counter this, the G7 countries are thinking about releasing a whopping 400 million barrels from their strategic reserves. The catch? That only buys the world about 20 days. And even if they release all 1.2 billion barrels, it's just a 60-day fix. This supply shock is a much bigger deal than the Russia-Ukraine conflict, with some analysts predicting oil could soar to $200 a barrel. The U.S. is stepping in with a $20 billion reinsurance program for oil tankers and is considering naval escorts to force the strait open, though this comes with its own massive risks. Meanwhile, the stock market is feeling the heat, with the S&P 500 dipping and potentially heading for a normal 10 to 13% correction. For crypto, it's a weird scene. Bitcoin is just trading sideways, stuck in a range since early February. Lark points out the uncomfortable truth that Bitcoin and Ethereum are basically at the same price they were in late 2021, making crypto a tough hold recently compared to equities. He looks at historical data showing that big volatility spikes usually lead to higher Bitcoin prices down the line, but also highlights a fractal that suggests a scary 40% drop could be on the table. The key level to watch for Bitcoin is around $64,000. If that's lost, things could get dicey fast. The situation discussed in the video has escalated into a full-blown conflict, with recent reports from early March 2026 confirming joint U.S.-Israel airstrikes on Iran and the effective closure of the Strait of Hormuz. This has thrown global markets into turmoil. As predicted, crude oil prices have surged, with both Brent and WTI crude futures blowing past $100 a barrel and briefly touching nearly $120. G7 finance ministers are actively discussing a coordinated release of 300 to 400 million barrels from strategic reserves. But as the video correctly points out, this is a temporary solution to a massive supply disruption. The crypto market's reaction is complex. Initially, Bitcoin is behaving like a risk asset, showing volatility and dipping with traditional markets. Recent data shows Bitcoin has been trading in a sideways range, struggling to gain clear direction amidst the geopolitical uncertainty. While institutional ETF demand has softened with recent outflows, some options market data for March expirations shows a bullish tilt, suggesting some traders are positioning for a potential recovery. The key tension remains whether Bitcoin will succumb to the macro pressures of a potential global recession triggered by the energy crisis, or if it will eventually act as a safe haven asset in a world of inflating fiat currencies. For now, the market is on a knife's edge, reacting to every development out of the Middle East.
In the latest video from the CryptoTips channel, the host explains why understanding geopolitics is essential to truly grasp Bitcoin's value beyond just price movements. He argues that you can't weather market panic without understanding the bigger picture. He points to the massive U.S. spending on the war with Iran, which hit $5.3 billion in just 1 week, as a sign of deeper problems. This conflict, he says, is more than just a military one. It's a religious and spiritual battle that could have long-lasting consequences. The host highlights John Adams' warning that a nation can be enslaved by debt, arguing that the U.S. is imploding under the weight of being the most indebted country in history. This situation, combined with Gulf countries considering pulling over $2 trillion in investments, puts immense pressure on the U.S. dollar. He believes the dollar may not survive the next decade. The conversation also touches on the soaring costs of shipping and the potential for oil to reach $150 a barrel, which would dramatically increase the price of everyday goods. All these factors, war, debt, and the potential decline of the petrodollar, are presented as powerful reasons why fiat currency is set to lose value rapidly, making a strong case for holding Bitcoin. The speaker's analysis, though referencing past events, taps into themes that are more relevant than ever in 2026. The core argument that geopolitical instability and unsustainable government debt undermine fiat currencies resonates strongly with the current landscape. Today, the U.S. national debt has ballooned to over $38 trillion, a figure that continues to climb by billions each day. This relentless borrowing, coupled with persistent inflation, keeps the de-dollarization narrative active. Nations within the BRICS bloc continue to explore alternatives to the dollar for international trade, chipping away at its dominance. While the dollar remains the primary reserve currency, its share of global reserves has been slowly declining as countries diversify. In times of conflict, the dollar has recently acted as a safe haven asset, strengthening amid global uncertainty. However, Bitcoin is also carving out a role, with some investors turning to it as a hedge against the very systemic risks the speaker described, showing resilience and even rallying during recent geopolitical flare-ups. The debate over Bitcoin's safe haven status is ongoing and often contradictory, but its performance during specific crises suggests a maturing perception of its value outside traditional financial systems.
In the latest video from Coin Bureau channel, we're looking at a wild proposal that could have rewritten Bitcoin's most basic rule. Imagine a plan to perform a hard fork on the network to get back billions in Bitcoins stolen from the old Mt. Gox exchange. Mark Karpels, the former CEO, put forward a code change to recover nearly 80,000 Bitcoin, worth over $5.2 billion, that had been stuck in a wallet for 15 years. The idea was to create a new key to unlock these funds, completely bypassing the original cryptographic rules. This sent shockwaves through the community because a move like this could trigger what's called a doom loop. If the community splits on the change, you get two different Bitcoins. Exchanges would freeze up, liquidity would vanish, and the market could face a catastrophic crash. Luckily, the proposal was shot down almost immediately, getting blocked as spam within 17 hours. This shows the social consensus to keep Bitcoin unchanged is incredibly strong. However, the video points out a much bigger, hidden threat. The launch of spot Bitcoin ETFs has brought Wall Street giants like BlackRock into the picture. These firms hold so much Bitcoin in their funds that their legal documents give them the power to decide which version of Bitcoin is the real one in a future fork. This effectively gives them kingmaker status, shifting a huge amount of governance power from the decentralized community to a few financial institutions. This not only challenges Bitcoin's core principles, but also jeopardizes its legal standing as an immutable asset, which protects it from government interference. The immediate crisis is over, but it exposed a serious vulnerability that will surely be tested again. The video's scenario, while hypothetical, hits on a very real and growing tension within the Bitcoin ecosystem: the clash between its decentralized ethos and the centralizing forces of institutional adoption. The concern that an entity like BlackRock could become a kingmaker in a contentious fork is not far-fetched. As of early 2026, reports indicate that spot Bitcoin ETFs hold a significant percentage of the total supply, with BlackRock's IBIT being a dominant player. This concentration of custodied assets in the hands of a few traditional finance giants represents a fundamental shift in network influence. The swift community rejection of the fictional proposal reflects a strong adherence to the principle of ossification, the idea that Bitcoin's base protocol should be resistant to change to preserve its stability and value proposition. This philosophy is what underpins its immutability, a feature that many believe is its primary defense against censorship and control. However, a successful hard fork to recover funds similar to Ethereum's DAO fork would shatter this perception and could set a dangerous precedent, potentially inviting regulatory demands to reverse other transactions. The episode serves as a critical thought experiment, highlighting that the biggest future challenges to Bitcoin's governance may not come from rogue developers, but from the very institutions bringing it into the mainstream.
In the latest video from CryptoWendy, we hear that traditional financial analysts are backing XRP for its synergy with AI and blockchain, its use in stablecoins, and its potential for bigger short-term gains compared to Bitcoin. It's apparently the second most popular crypto for retail investors, and there's buzz about an XRP spot ETF pulling in over $10 million. Ripple's recent business acquisitions are already bringing in money and making things more liquid. An analyst in the video suggests that for quicker returns, Ethereum and XRP are better buys than Bitcoin right now, pointing to XRP's connections with banks. The conversation also touches on how the financial world is changing, with a big role for stablecoins and easier ways to send money across borders. XRP's lower price is seen as a psychological plus for new investors. Ripple is also building out its stablecoin services with new platforms that have already handled over $100 billion in transactions. Moves by companies like Hidden Road and Doppler Finance are set to connect traditional finance with DeFi, which should bring more money and utility to the XRP ecosystem. The video's bullish stance on XRP taps into several key narratives circulating in early 2026. AI blockchain convergence, stablecoin infrastructure, and institutional adoption. The analyst's preference for XRP and ETH over Bitcoin for short-term gains reflects a market searching for higher beta plays. The mention of Ripple's acquisitions and the Hidden Road integration with the NSCC is particularly relevant, as these are concrete steps toward bridging traditional finance with digital assets. However, the market sentiment remains a significant hurdle. Recent on-chain data from March 2026 indicates that a substantial portion of the XRP supply, roughly 36.8 billion tokens, is at an unrealized loss, which could create selling pressure. The path forward for XRP is heavily tied to broader regulatory developments. The proposed Clarity Act in the U.S. is a major factor, as its passage could provide the legal certainty that institutional players require before committing significant capital. Ripple CEO Brad Garlinghouse himself has framed XRP's success as a long-term play, urging investors to look 5 years ahead to 2031. While the convergence of AI and blockchain is a powerful long-term trend, its immediate impact on XRP's price is still developing. Similarly, while the stablecoin market is maturing with clearer regulations, Ripple faces stiff competition. Ultimately, the analyst's short-term optimism hinges on market psychology and the successful execution of Ripple's long-term strategy in a complex regulatory and competitive environment. After analyzing these different perspectives, one thing is clear. Crypto is at a major crossroads, caught between powerful external and internal forces. There's a broad consensus that geopolitical instability and the deep influence of Wall Street are fundamentally changing the game, challenging crypto's core principles. But the key disagreement is on Bitcoin's immediate role. Is it the ultimate safe haven from fiat decay, as some argue? Or is it just another risk asset, vulnerable to market shocks and institutional control, as current price action suggests? The key takeaway is this: Bitcoin's long-term promise is being tested in real time, and its performance now will define its future.